Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at why IV matters, why implied volatility is such a meaningful aspect of option trading, especially on some of these AI names that have shot to the moon on price, but more importantly, shot perhaps even further to the moon on implied volatility, as we'll see in a second, and why it might be time finally to take advantage of the highest IV ever. So today we'll be talking about advanced micro, but certainly applies to almost all of the AI names and to the SMH, the semiconductor holders as well. As we always like to do, we take that fusion approach here at Big Time Options, looking at fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, here's a quick look at the fundamentals just brought off price to sales and price to earnings on AMD. So here's a 10-year chart on price to sales. I use 10 years on price to sales and not PE simply because for most of the past decade, AMD was actually losing money, so PE was negative, kind of a disoriented chart. But price to sales, as you can see, certainly exploded to the highest multiple we have seen over the past decade by far. Here's a shorter term look year to date on it. You can see now pushing towards 24 times price to sales. Was only a few decades ago when people were talking about, 2 or 3 times price to sales being expensive. So certainly valuation multiples have absolutely ripped to extremes here on AMD. Here's a year-to-date PE ratio chart. You can see for most of the first 3 months, as we take a look, PE was certainly not cheap, but trading about 75 times. Now you're seeing price to earnings more than double that, as the belief in the AI mantra perhaps getting to an extreme would be hard to imagine a further multiple expansion from here, in my opinion, given this parabolic move we have seen in all this, but we shall see. But certainly fundamentals getting stretched, probably due for a cooling off period, especially given the fact that interest rates not looking to come down anytime soon, both on the short end, the Fed funds, and the longer end, the 10-year yield, still chopping around that 4.5% level. So this huge run up in valuation multiples without a corresponding drop in interest rates makes the valuation multiples even more extreme, to say the least. We always like to look at the technicals too, and you can see AMD finally maybe starting to slow down here, right? We saw MACD reach a crescendo, right, post earnings. Here were earnings coming out. That was at the beginning of the month on May 5th, right? Beginning of May, I should say. And certainly beat nicely, right? Down the road, they're looking for even more massive beats here, at least by the valuation multiples, to say the least. But you can see the stock kind of topped out just below that 550 area, kind of like this kind of price action where you get that kind of doji where it rallies to a fresh new all-time high, but then struggles, pulls back here. We'll see if it breaks back out above there. Actually briefly drop below the 20-day moving average. You can see 9-day RSI kind of at midpoint around 50, right? MACD, right, had gotten actually kind of flat here and then got a little oversold, starting to strengthen a little, but perhaps that, huge run up that we saw here, right, to begin, kind of the second quarter has at least slowed down. That's all we really need on the couple trades we're looking at here. Bollinger percent B, also middle of the range, but implied volatility, a general look, as you can see, at by far the highest level we have seen over the past year. As we always like to take a look at implied volatility, simply brought up a chart of the 120-day IV here, right? You can see it reached a new high over the past 12 months, right? Pushing to extremes from Thursday to Friday. You can see, especially in the long end, right? Thursday's close in red, Friday's in green, actually went higher as well. Here's a generalized sort of 20-day look at the IV. You can see 20 days ago was trading at around 65, right? Now we're trading at about 75 at the highest level over that period as well. You can see the January IV moved up 2% or 2 vol points. You can see the IV rank, the 30-day IV rank at 100%, meaning option prices have not been this expensive over the past year. Here's another look from Thinkorswim, basically the same mantra there, 99 percentile. So options, the highest they have ever been, pulled off a 5-year chart of a 120-day 50 delta call option from an IV perspective. And here you can see that huge run up, right, that we saw in IV. So it had been pretty much contained right around that kind of mid 50 level with kind of pumps and dumps, but we saw this rip higher, right, to basically start the second quarter back in March as we looked at that chart here, now reaching an extreme, the highest level. You can see previous spikes never lasted too long, right? All these previous spikes, many of them earnings related, right, simply fell back to earth. Hard to imagine a further continuation of this. You do never know, right? As we know, trading's all about probability, not certainty, but certainly getting to an extreme from an IV perspective, to say the least. Also, a shorter term look. This is simply the shorter term chart, a 6-month chart, and you can see basically again trading around that mid 50 level, and lo and behold, once we started the second quarter back in early April, right, you can see that huge run up, right? Now we're trading at over 75. So simply looking for IV to soften somewhat, not even head back towards 55 where it had been obviously for a very long period of time, right? But simply maybe pull back 5 vol points to that 70 level. So that sets up ideally for a couple trades out there. So I took a look at going back a little over a month ago, right, until now, right? So going back to May 22nd, right, looking at the January of next year, 500 put, 600 call, sell straddle. The stock was at roughly 450 at the time, right? At sell straddle closed just under $179, trading at roughly about a 68 IV, right, with the stock again at 450. Then fast forward to Friday's close, we can see the stock closed higher, right, 511.57. At a ideal point, if you're short the 500 puts and the 600 calls, you want it to be between the two strike prices for a sell strangle, right? But because of the huge jump in IV, which is now at 74, that sell strangle actually increased from 179 roughly to over 190, all because of that huge jump in IV. So a quick side by side here, right? The 500, 600 strangle, as we said, moved up over 11 points, right? Even with the stock moving towards the ideal price, right? You want it around 550 come January expiration, right? So on May 22nd, that strangle was trading at about 179 bucks. You would have been 4 deltas net long, selling that in the money 500 put and selling a way out of the money 600 call. You would have had about 40 cents a day theta, so in other words, time decay would have obviously been a big benefit to you on the trade, right? Simply because you'd have time decay of 18 cents and 22 cents here. The delta, 42 delta you're selling, a negative 46 that you're selling, so you'd be 4 deltas net long. So slightly bullish at inception. The stock did move up about 62 points, right? The delta did flip to slightly negative, 16 deltas net short, right? The theta increase, right, because of the jump in the price of that sell strangle, right? You'll have more time decay coming off, so time decay actually improved greatly. So our expected delta loss by the move in the stock, since I smoothed the delta, started at a positive 4, ended at a negative 16 delta, right? So you'd be over the course of that a smooth delta, about 6 deltas net short, with a move of 62 points roughly. You'd expect to lose about $3.70 from a delta perspective, but you'd expect to make, because we had 21 days pass, right, and you're making about 45, 46 cents a day, right, you'd expect to make about 99 bucks or so on time decay on the trade, right? So your expected gain with the delta loss and the time decay or theta gain, you'd expect the trade to actually improve, to drop in price almost $6, but it actually went up in price, right, by over 11 bucks, right? So that gives you a nice vol edge of 17 plus points, right? The reason for that huge pop, right? Here's that IV move, moving from 68 roughly to 73 and a half. And if you simply bring it back down to that 68 level, if we go down to the theoreticals here, you can see the Theo on the trade. I simply dropped the IV back to roughly 68 and 69 respectively on the call and the put. The Theo would be 173.31 on the trade, right? If it had just hung out again, not anywhere down here, right, but moving back towards this level, that kind of 5 vol point drop here. So that is the edge you get on implied volatility. Taking a look at the 550 straddle, a similar trade, right, going out to January, you can see the stock closed at 450 roughly, right? So the put $100 in the money, right? The call $100 out of the money. Ideally, you want the stock moving towards 550, which it did. That straddle closed at a little over 225 back in late May, right? Fast forward to Friday, the stock closed at 511.57. So moving towards the ideal price. Plus, you had time peel off, so time decay should be a benefit. So beneficial stock move, right? Absolutely time passing off. You expect that sell straddle, right, to drop in price. But lo and behold, it actually increased by over 10 points. Why? Because of that huge jump in IV of about 5.5 vol points. So again, just doing a quick, math back of the envelope here. Stock was at 450 roughly back in late May. They had 550 straddle trading at 225 and change. You would have been 5 deltas net long at inception, positive delta or theta, I should say, because you're selling it, right? You'd expect to make about 40 cents a day in time decay. The IV just under 68 back then. Fast forward to Friday, right? The stock moving towards 550, the ideal price, right? 511.57. The delta, however, now turning negative because of that huge jump in IV. You get the upward drift in deltas, especially on longer term options. So you'd be 16 deltas now net short. More theta heading your way by selling it over 50 cents a day, right? So your expected delta loss on the trade, right, you would have been roughly the same, about 5.5 deltas net short on a smooth delta basis over that time frame. So you expect to lose about $3.70 from a delta perspective, because the stock did move up almost 62 bucks. Theta, you'd expect to make about 9.5 bucks on theta, right? Since you're making somewhere around 45 cents a day. So overall, your expected gain on the trade would be about $5.70, but the trade actually went the other way by over 10 points, almost 11 points, giving you a nice 16.5 point or so vol edge, right? So that straddle, right, if we go take a look at that from the Theo perspective again, right, you can see the 550 call and put in again, just moving it down 5 vol points from where it was at to where it is now. Theo would be somewhere around $220, which equates nicely, right, to that vol edge, right, when you have that vol edge of 1650 and that trade closed at 236, somewhere around 220 is that volatility edge by having the vol pop even further, another 5.5 vol points. So always important to look at the implied volatility. Taking a look at the covered call trade too here, this is interesting. So going back again to our May 22nd date, the stock was at roughly 450. The Jan 600 call, right, had IV, as we said, at 68.20. It was trading roughly at 56.5 bucks or so. It'd be 22 thetas as far as thetas positive, right? So you'd have time decay heading your way. 42 delta, so you're able to hedge off almost half of your overall delta. You'd end up 58 deltas net long. So the stock back in May 22nd, 449.59, the 600 strike was out of the money by about 150 points or 33%. The price of the option, 56.65. It would provide you 12.6% downside protection. That's simply the price of the option, right, divided by the stock price. IV was at 68.20. Fast forward now to Friday's close, and I went out to the 700 call, right, which because of the IV jumped to 74.11, trading at 65.50, right? So that 700 call trading at a higher level, yeah, the stock price went up, right? But you're further out of the money. So you are now out of the money by over 36.5% instead of just under 33.5%. So you got 3% further upside cushion. You have shorter time frame, right, by 21 days, right? And you have bigger downside protection of 12.8%, right? The price of the option divided by the price of the stock, right? All because the IV exploded to over 74 vol points. So you're able to sell a covered call that has bigger upside, right? 36.83% out of the money versus 33.45. So you have more upside potential, right? You have better downside protection, right? 12.8% versus 12.6%, right? And 21 days less time frame. So everything fits in nicely for anyone looking, I think, selling some covered calls against not only AMD, but most of these AI names. You can get further out of the money, bigger downside cushion, right, to protect yourself against it, right? So anytime you can have more upside, greater downside protection, get paid more for it, to me makes a lot of sense. So hopefully it provides some insight into how we go about looking at things here at big time options. But as we always like to say, trading is about probability, not certainty. Make sure you position size accordingly. If you don't know where to get out before you're getting in, you shouldn't be getting in. But taking advantage of that implied volatility, right, that is actually rocketed to extremes, looking for a reversion back at some point here. The nice thing about implied volatility, it rarely stays elevated for too long, right? It's getting parabolic. So look for at least a pullback in IV, and because IV is at such an extreme, the highest IV ever, you get a much bigger cushion for the stock to move while you're waiting for that reversion. So until next time, as always, here's to good trading. Take care.